Thank you, Joe, and good morning, everyone, and welcome to Federal Taxes and the Small Business Owner. So for the next 30 minutes, we're going to talk about the taxes that you pay, and I expect it to be an exciting and an informative session about what taxes you pay as a business owner. And when I say exciting, why would taxes be exciting? Well, generally it means if you're paying taxes, that means you're making money with your business, and we can all agree that that's exciting. So buckle up and here we go. All right, so here are the objectives of the session. We're going to talk about three things. We're going to talk about the type of federal taxes that a business in Washington may be required to pay, a business, and then the type of federal taxes that a business owner might be required to pay. And then we're going to talk about how to pay and report those taxes, because it's not as easy as it could be. My name is Gary Becker. As I said, I am a volunteer with SCORE. I'm a business mentor. And before joining SCORE, I was a CPA. I worked at a tax firm focusing on small business clients. I've been a chief financial officer, and I've done other things in my career. But again, being a mentor at SCORE is my reason for being here today. All right, moving on. So we've got three things that we're going to cover after the introduction. We're going to talk about federal taxes on business profits paid by owner, and some other bonus stuff at the end. The best way for you to profit from this session is to engage. So even though it's a virtual session, we are answering questions live behind the scenes. So I encourage you to drop your questions into the Q&A. And I will be answering those as we go along during the session, and then for some time after the session ends as well. And then if for some reason I haven't answered your question throughout this, then chances are it's because you stumped me and I got to go do a little research, but I will definitely get back to you. Okay. I encourage everybody to download the presentation. There's going to be information in here and some links in here that are helpful, some calculations. So, please do please do download the session and take it with you. Okay. All right. So let's dive right in to the first part on federal taxes on business. Now, I'm going to say that the federal taxes on business are exclusively for those who have employees. Either they have employees as part of a sole proprietorship, or they're an S corp and they have themselves listed as an employee. But basically, if you don't have employees today, or you're not planning on hiring employees in the immediate future, you can listen, because hopefully someday you will have employees, but this first part of the presentation won't be as relevant to you as the next part of the presentation. Okay, so for those of you that have employees, there are three types of taxes that you'll be responsible for paying and remitting: Social Security, Medicare, and federal unemployment tax. Social Security and Medicare, we sort of combine those because it's a single payment. They're common programs that do different things, and most of you probably aware Social Security, Medicare for those workers that are at the end of their career, and Social Security provides some retirement benefits. Medicare provides some medical benefits. Okay. All right, let's start with Social Security and Medicare payroll taxes. These taxes are paid by anyone that has an employee, as I said, and they're also paid by all employees of the business. So in other words, this is a tax that's split 50-50 between the employer and the employee. So as we go through this, keep that in mind, that you as the business owner will be responsible for 50% of these, and then you'll be required to withhold 50% of the payment from your workers. All right. So let's get into the nuts and bolts of it. Social Security tax rate this year, and it does change yearly, is 6.2% of the first $147,000 of wages paid to each employee. And again, that is paid equally by the employer and employee. And so the total for Social Security tax is 12.4%, the combined tax on both you and your employee. Medicare, 1.45%, and then combined it's 2.9%. So if you take those two into account, you've got 15.3%. So that's generally the tax on the employees. Again, split that 50-50. One caveat: if you've got employees that are making more than $200,000 a year, there's an additional 0.9% on their wages for above 200,000%. So I guess the important concept here is that on Social Security, there is a cap. That cap is $147,000. So once employees are making more than that, you don't have to withhold any additional taxes. You don't. And on Medicare, there is no cap. So on Medicare, you're going to tax all the dollars, and then you're going to tax a little bit more if you get up to $200,000. All right. So let's go through an example, because that sort of brings some life into all these numbers. Let's say that you were the owner of a ABC LLC, and you had 2 employees. Each of those employees made $40,000. So combined, they made $80,000. So what's your tax? Well, you can see the calculation below. Your tax is 6.2% of $80,000, okay? And then 1.45% of that same $80,000. So the total tax is $6,120, and that's the portion that you, the employer, pays. And then additionally, you'll have to withhold $6,120 from your employee, and so a combined rate of $12,240 is what you'll be withholding, and then you'll need to send that money that you've withheld, both from yourself and from your employee, to the IRS. Okay, and we'll talk about that in a moment. Not to the IRS, but to the Social Security Administration. All right. So how do you take care of these taxes? Well, there's 3 ways to do it, and we're going to walk through those 3 ways. The first thing you can do is you can do it manually. So you can take out an Excel spreadsheet, go through a calculation just like we saw on the straw on the previous slide, or you can take pencil and paper and do it manually that way. So that's one way to do it. And then there's 2 other ways. You can get a bookkeeper to do it, a professional accountant that will take care of those for you. And then the final item that we'll talk about is actually contracting with the payroll service directly. So let's talk about the first method. We don't recommend that you do your payroll manually. And the reason is simply, it's a lot of work. It's a lot of work. There's a lot of complexity. There's a lot of accountability too. So if you don't know what you're doing, or you make a simple mistake, there can be pretty significant consequences. But again, the amount of work that it takes to both learn it and do it continuously it may not be the best use of your time in your business, unless maybe you're in the bookkeeping business. And if you're in the bookkeeping business, then you probably wouldn't be doing this manually. You'd be relying on. So there's no good reasons that we can think of to do payroll manually. But if you did, just say, for example, that you wanted to put yourself through this, here's what you would do. You'd compute the gross pay. So on the slide before, $80,000. You'd determine how much needed to be withheld. Okay, we did that calculation on the previous slide. You would pay your employee the net amount of their pay, so after that withholding. And then you would have to report and pay those taxes to the IRS. Okay, how do you pay those taxes to the IRS? The first thing you have to do is know when your due dates are. And the due dates can be complex, and they're dependent on how much tax that you have withheld. Okay, so if you've only withheld a little bit of tax, then you're fine paying this within 30 days at the end of the quarter. If you've withheld a medium amount of tax, then you have to send that in within 15 days of the end of the month. If you've withheld a lot of payroll tax because you've got lots of employees, then the IRS wants that tax within 3 business days after you've paid the employees. So again, depending on your situation, you're going to have a different deadline. And if you're doing this manually, that's something that's going to be up to you to manage. All right. In addition to submitting the funds that you would have withheld, there's also a requirement that you report out on the amount of payroll taxes that you withheld each quarter. Okay, and you report it on something called the Form 941. 941, pretty easy to find. You can go to the IRS If you download this presentation, there's a link there, and you fill out this form and you send it in at the end of each quarter so that the IRS knows exactly how much has been withheld. Okay, and that should match, obviously, what you sent in. And then one other step. Each year, you will also be required to issue a W-2 to all of your employees that you've withheld taxes on, and you'll need to submit what's called a W-3, which is just an annual summation of all of the taxes that you've held. So it's the sum of your 4 quarters. Okay, so W-2, W-3. Don't forget about those at the end of the year. There's deadlines on those as well. And again, as you can see, this is sort of why we say, consider whether it's worth your time to do bookkeeping manually. Another option is to hire a bookkeeper. Bookkeepers are generally going to be very experienced. They are somebody that you can talk to and hold accountable, which is good. So those are the pros of hiring somebody. It's you can take this issue, outsource it, and be fairly assured that it's going to run smoothly. There are some cons. Number one is that this is the most costly option of the 3 that we talked about. So you will be paying a bookkeeper. Can be up to $300 a month, maybe more, depending on all the things that they do. To run payroll, probably not that much. Normally, they're going to just use a system that is pretty easy to do. And so as we get into the next slide, we're going to say, consider using the system directly. And then finally, the one issue with bookkeepers is that if they go on vacation or if they just can't be reached, somebody's still got to run the payroll. Your employees still have to be paid. And so that is one of the cons of relying on somebody else. And we've seen that happen to SCORE clients before. So it's not a theoretical situation, it's a practical situation. Okay. All right, well, let's talk about some payroll systems that you as a business owner could contract with directly. There are 4 that we that are out there. There's actually more, but these are 4 that we've looked at. All good systems. You can't go wrong with any of them. So, ADP, Paychex, QuickBooks Payroll, and Gusto, all payroll systems that you could consider. We think that Gusto, of those 4, is the most suitable for a small business owner. And this is one that we're comfortable as SCORE Seattle recommending to small business owners. The reason we recommend it is that it's built for small business. There's over 100,000 small businesses on it. It's super easy to use. Compliance is a top priority. As we talked about, there's a lot of steps to take care of. And as we'll talk about soon, there are consequences for not being compliant when you do this. And so a system that has compliance as a top priority is important to you. Good support, and the pricing is very competitive compared to these others. I'm not going to get into all these features, but certainly these are good things that allow as much automation as possible into the process, which is good for you because anything that's automated is a manual step that you don't have to do. Some important things are, the W-2s, the 1099s, all of the reporting that needs to be done that we just walked through. Gusto will take care of it automatically for you. So, and again, here's the pricing. So it is as low as $46 per month. If you have 1 employee, it's $40 for the package plus $6 a month. So $46 a month, which is very reasonable compared to the time it might take you or what it would cost as a bookkeeper. So again, Gusto is what we recommend. If you want more information, then I would encourage you to go to their website or talk to your business mentor about it. They can put you in touch with me or others in SCORE, Joe, for example, that can tell you about it. Or you can send me an email and I'll be happy to talk to you about it as well. All right. So one of the important concepts about employees or about people working for you in general is how you classify them. So we've been talking about employees, but there's another type of worker that you could engage with. It's called an independent contractor. The thing about independent contractors and employees is that there's different ways to treat them. If you have an independent contractor, there's much less tax compliance that you have to worry about. But the thing to remember is that there are rules around when somebody is a contractor and when somebody is an employee. So it's not necessary. It's not up to you to decide that. It's, you could structure the work to be done to favor one way or the other, but be aware that there's very strict guidance from both the IRS and the state of Washington. And by the way, the state of Washington has more strict rules. And so if you're running a business and employing people in Washington, then you'll need to snap to the state of Washington's rules. Okay. And there's several criteria. There's 6 or 7 criteria, depending on what industry you're in. But the 3 most restrictive are, is the worker free of the business's direction and control? So in other words, does that worker get to decide what they're doing, or are you telling them when to be there, what to do, what the outcome is? So the more prescriptive you are about what the worker needs to do, the more likely you are not meeting this criteria. Okay. Is the work performed away from the business's normal place? So if you're running a flower shop and you have a worker come in and cashier at the flower shop, you're probably not going to meet this criteria right away. So, we're looking for the work to be performed by the person at home or somewhere away from your normal place of business. And then another important factor is, do they provide that same or a similar service to others, or are you the only person that they're providing that service to? So that's another one of those indicators. If you answer no to any of those or some of the other criteria that's there, then you do not have a contractor, you have an employee, and you have to follow all of those payroll rules that we just talked about. All right, let's move on. What if you decide, well, I'm going to take a chance and call somebody a contractor when the rules suggest that they're an employee? There's some really significant consequences, back taxes, penalties, interest, a Department of Revenue audit, which is not one of the things that I would wish upon you. Love auditors, was one myself once, but they can completely disrupt your day. So again, this is an area where if you've got any question, I would encourage you to seek some guidance on whether somebody's an employer or a contractor. You don't want to make the wrong decision here and then end up with some pretty significant consequences down the line. Okay. All right. And finally, let's talk about federal unemployment tax, because that is it's small, but it's there. So it's a small tax. It is 0.6% on the first $7,000 of wages that you pay to each of your employees. So $42 is the max that you'll pay per year. So be aware that it's there and that you do have to report it. Okay, so you report those on your Form 940 at the end of the year, and there you go. Okay. All right, so that's the end of the federal taxes on businesses. We talked about Social Security tax, Medicare tax, and federal unemployment tax. We talked about how to classify your workers properly. And then we also talked about our recommendation to consider a payroll service like Gusto if you're going to do payroll. Okay, we are now moving on to the next topic, which is federal taxes on business profits paid by owners. All right, an important concept that we want to talk about right now is pass-through profits, okay? Business profits for most types of corporation or most types of businesses will pass through from the business to the owner. In other words, the business isn't taxed per se. They'll fill out a tax return, but there's no taxes paid by the business. Those profits go to the owner, and then the owner pays the taxes. Okay, so let's talk about some definitions before we go too much further. Profits. Profits, when we speak about those in the next few slides, are your sales minus the expenses of the business. Okay, those are your profits. Generally, your profits are going to be taxed with some differences. Deductions. Deductions are all business-related expenses with a few small differences that we'll talk about. Taxable income is your profits with some adjustments, which are not deductible. Okay, so taxable income are the profits that are not deductible. Okay, and then finally, we're not going to spend a lot of time on it, but distributions or owner draws. I get this question a lot. Hey, if I'm taking money out of the business or putting money into the business, how is that treated for tax purposes? The answer, it is not. It's not an expense if you're taking money out of the business, and it's not income if you're moving your personal money into the business. That's just, it's the equity, it's the ownership of your business, and it doesn't impact your taxes. All right, so now that we have an understanding of definitions, let's talk about business deductions. Business deductions are the business-related expenses that are paid for by your business, with a few differences. And first of all, what is what is deductible? That's a question that I get a lot. The answer is a business expense is deductible if it's ordinary and necessary. That's what the IRS says, ordinary and necessary. Well, who gets to decide what's ordinary and necessary? Well, kind of you do, but just know that there's some guidance. There's volumes of tax cases that have been decided around this question. So know that the IRS has a point of view on what's ordinary and necessary. And in the unfortunate situation that you had a tax examination, this would be maybe a question if there are any expenses there that they don't immediately see as ordinary and necessary. So I have a client who runs a yoga studio. She buys candles. And the question was, is that ordinary and necessary? Well, maybe lots of yoga studios buy candles. So leave it up to her to make that determination. Necessary, can you make a case that those candles are necessary for setting the mood in the yoga class, or as a backup in case the power goes out, whatever it is. So sort of up to the business owner to make the case. And certainly you can engage tax professionals to get some guidance on those things. All right, so ordinary and necessary, remember that. That's an important concept. Reductions from deductions. So you might have ordinary and necessary expenses, but there are a couple of cases where the IRS says, sorry, you can't deduct all of those. Business meals in most years are only 50% deductible. There's an exception this year, so we won't go into that. But business meals, remember, there's some additional rules around those. Charitable contributions. Hey, if I donate my services to a charitable organization, how do I deduct it? Well, you can't. Businesses can't deduct their charitable contributions. An owner might be able to, if they itemize their personal taxes, they might be able to itemize it. They might be able to deduct charitable contributions that way, but a business cannot. Okay, there's some additions to deductions. If you've bought some equipment and you weren't able to expense all that equipment in 1 year, then the depreciation expense, the cost of that equipment over many years, is something that you can deduct in addition to your business expenses. And some of the ones that are often overlooked, but home deductions. So if you're using your home to run part of your business or your personal vehicles, there are expenses associated with that that would also be deductible. Okay. The key federal taxes that a small business owner pays on their profits are these two: self-employment tax and federal personal income tax. Okay, so those are the two that we're going to talk about. Federal self-employment tax is paid if you have a sole proprietorship or a partnership. If you have an S corp, then you have employee wages, and so see above slides for how to treat those. But if you're a sole proprietorship or a partnership, then you are going to pay self-employment tax. And if you don't know what this is already, stand by, because it's a pretty hefty tax. So your self-employment tax rate as a business owner is 15.3% of the first $147,000 of business profits. Okay. And then, there's an additional 2.9% tax if your profits are over $147,000. And so you might be thinking, hey, those numbers look familiar. And what those are the combined rates between the employee and the employer that we talked about in the earlier slides. As a business owner, you are both the employer and, effectively the employee. And so you have to pay all of those taxes on your own. As you can see, it's a pretty hefty tax, 15.3% plus potentially another 2.9%. Okay. All right. So real quickly, let's go through an example. Let's say that you ran ABC LLC. Bobby Long has profits of $80,000. Then her self-employment tax would be 15.3% of that $80,000. There is a deduction for some of the self-employment tax that Bobby gets to take on her personal tax return. But generally speaking, the $12,240 of tax on this $80,000 of profit. So again, big tax. You report it on the federal self-employment tax SE, and this will end up on your Schedule C and your personal tax reporting. So let's walk through that. Okay, so Schedule C of the 1040 is where your business profits go. So it's a schedule that gets attached to your 1040. If you're a partnership, you're going to use Form 1065 to report your profits. And if you're an S corporation, Form 1120S. So those are the three tax forms that are used for the three taxing regimes. Okay. All right. So assuming you are a sole proprietorship, your Schedule C is going to have your net profits down here on line 31. That's going to roll forward to Schedule I, line 3 on your 1040, and then that comes up into the face of your 1040. So, line 8 is where you report other profits, and then all of that gets taken into account with all your other income, everything else that's going on in your personal life to calculate your taxes. And what's helpful is to think of a real world example. So in a real world example, Bobby has a spouse who is earning $75,000 in outside wages. Bobby's married. The couple has income of $500. There's a deduction. We talked about the self-employment deduction, so that comes off of the business profits. There's a joint. There's a standard deduction that they get for being a married couple. And then there's something called the qualified business income deduction. And basically that's the 20% of the profits gets deducted as well. And so that brings a total tax liability of $12,223. So how did that $12,223 get calculated? We're going to walk through exactly how that works in a couple of slides. First, know that there is a tax table that gets updated every year by the IRS. And in that tax table, there are unmarried, married filing jointly. There's also one if you're head of household that's not on this slide. But the mechanics of how to calculate your tax liability can be found in the tax table. And let's apply that tax table to Bobby's situation. Okay. So as we said, Bobby had, $95,406 of federal income tax. Okay. So 10% of the first $20,550 from that tax table is tax, and that comes out to $2,000 and some change. The next $63,000 is taxed at 12%. So as you can see, the tax brackets are pretty low, which is good. As soon as Bobby and spouse get over this $83,550, they're now in the 22% tax bracket. This is their marginal tax bracket, and so all the dollars between $95,406, their total income, and $83,550, the top of the next bracket, gets taxed at 22%. So that comes out to $2,608. And so $12,223 is what their tax is, and that's what we saw from the earlier slide. We also want to consider that Bobby had to pay self-employment tax of $9,500. So total federal taxes owed $21,709. Combination of the federal income tax and the self-employment tax. And so that is both the income tax, federal income tax on the 1040, and the self-employment tax. Those are the two taxes that you pay as a business owner. All right, so how do you pay your federal taxes? Well, you want to, I mean, there's three ways to do it. We don't recommend option one, which is really easy, which is wait until the end of the following year, the tax deadline, figure out what you owe, pay it. Okay. If you do that, you're probably going to get hit with penalties and interest because the IRS requires that you pay as you go. So they want you to pay on a quarterly basis, figure out what you're going to owe at the end of the year and make a payment. So there are ways to do that. And if you download the presentation, you can follow through, but estimating your annual income, dividing it by 4, sending in a fourth of what you owe once a quarter is, a good way to go. Or, if your taxable income is less than last year's taxable income, if you've had a decrease in your income, you can just take last year's amount owed, divided by 4 and send that in each quarter. Okay. All right. When do you pay? So, again, option one, you pay April 15th of the following year. We don't recommend that. We recommend that you pay quarterly. Those are due April 15th, June 15th, September 15th, and January 15th of the following year. So, so you make your estimates, in a couple of cases, you're making your estimates before the quarter's over and you're submitting your payments to the IRS. How do you pay it? Couple of ways. One, you can download this form called the 1040 ES. You can fill it out, you can attach a check, and you can mail it in. A better way, though, is to open up an electronic funds, an EFTPS government account and pay online. And the reason why we think that's a better way to do it is, A, it's definitely going to get to the IRS. It's not a piece of paper that's going to float around and hopefully get there and hopefully get applied to your account at some point. EFTPS, you're going to take the money out of your account on the day that you say, so set it up as the due date, and then it's paid into your account. All right, so that is the end of this section. We talked about self-employment tax. We talked about federal personal income tax. We talked about paying using the EFTPS, and we talked about the deadline. So that is it for that agenda item. All right, we're in the home stretch, a couple more minutes and we'll be through this. Let's talk about record keeping. You want to keep records because in the unlikely or in the unwelcome event of an examination, you're going to be asked to substantiate, to prove all of the business expenses, all of the revenue that you've had there, and you'll want to have the paper that goes behind what's there. And so as you can see, basically you keep everything that substantiates those amounts, your invoices, your receipts, your bookkeeping, all needs to be there. Okay, so keep good records. You can keep it electronically, you can keep it by paper, it's up to you. How you file it, the one thing we would recommend is that you file it in a way that's organized. By month is really good, but you can file it by supplier and customer, whatever you're comfortable with, whatever allows you to go and retrieve records if you have to substantiate numbers on your tax return. How long do you have to keep it? Well, 7 years from the date the related federal tax return is due. And so you'll file your 2022 return by April 15th, 2023. And so you're going to want to keep all of those records for the next 7 years to substantiate that. And so until April 15th, 2030, you keep those records. And then for your tax returns, keep those indefinitely. You would always want to have those around. All right. So what are the rules of the road for taxes? We encourage you to use all legal means to save and defer taxes. Okay. You want to minimize your taxes, but you want to be legal. When in doubt, if you're not 100% certain or 98.7% certain, seek competent advice. Set aside cash for paying taxes. Okay. Don't wait until it's due and then struggle to find the cash. So set it aside as you go along. And then finally, pay taxes when they're due, and be sure that you're fully paid up on the date of the return. Don't let the Washington State be a lender to you, and don't be a borrower from them, because the amounts that you pay are pretty egregious. if you've found, and the reason that we stress this so much is that, again, the consequences are significant. You can be asked to pay 100% penalty on the amount that's due for federal taxes. There's criminal prosecutions that can occur. So again, just pay your federal payroll taxes on time and in full. All right. Hopefully, we've met the objectives of this sessions, which were to describe the types of federal taxes that you pay as a business in Washington and the types that you pay as a business owner. And we've given you some information that you find useful on how to report and pay those taxes. Okay. I'm going to continue answering questions in the background until the session is over. I would encourage you to continue to submit questions, and if I can't get to them, I will, I'll keep going until I get answers to you. If you have any questions that come up after the session, download the presentation. There's my address. Send me an email. I'll give you an answer. Okay, and then try to take the learnings from here and apply it. And hopefully the knowledge makes you a little bit less stressed about about what you need to know about taxes. I want to thank you for your appreciation. It's been a pleasure speaking with you this morning, and enjoy the rest of today's sessions. Thank you.